Valuation methodologies, I'll be very brief because like I said before, this is actually well covered in alternative investments. And for purposes of portfolio management, we just need to have at least a brief synopsis or a brief understanding of, a general understanding of the alternative investments themselves. So now our focus is on real estate, and we're just going to have just a general or an overview of real estate investing. So for public forms, which of course include the mortgage-backed securities and REITs and REOCs like that, the valuation methodologies is based on we are just going to base it on the net asset values. So the net asset value approach. So net asset value, where you get the value of net assets. So you get the value of assets minus liabilities, you get the net asset like that. And if you divide by the number of shares like that, so the NA net assets, you divide by number of shares, you get the net asset value per share, net asset value, or NAV. This is NAV. So to get the NAV per share, you divide by the number of shares outstanding. So that is how you get the value of publicly forms for the first approach over here. So number one. Number two, we can be able to use funds from operations and adjusted funds from operation. So funds from operation approach. And funds from operation approach, you're seeing we'll just get the accounting net earnings, and then we deduct, we add the deferred tax component, which is expressed to us. So we add the deferred tax component. So we have accounting net earnings plus deferred tax and plus depreciation, and then we less gains from asset sales, So it's accounting net earnings, we add deferred tax, and then we add depreciation, less gains from asset sales right over there. And then we also less losses from assets, yes. So minus losses from asset, less gains from asset sales, and we add losses from asset sales, like that. So this is how we get funds from operations. We get the accounting net earnings, then we add deferred tax, we add depreciation expense, and then we less gains from asset sales and losses from asset sales right over there. That's the second approach, funds from operations. Number three is adjusted funds from operations. Adjusted funds from operations. And in getting adjusted funds from operations, we get FFO. So with this one, we begin from the FFO, or funds from operations. And then we less recurring maintenance type. Assets. And then we less, so we start with the funds from operations, we less recurring maintenance type, and then we also less non-cash rent as well, yes, minus non-cash rent, and then we are able to get the adjusted funds from operations. So the adjusted funds from operations minus recurring maintenance type assets minus non-cash rent, we get the adjusted funds from operations. That's the third approach of having public. Remember, we are valuing publicly for public forms of real estate, the ones which are traded on a regulated exchange. Then number 4 is the discounted cash flow approach. Discounted cash flow approach. The discounted cash flow approach, the formula is getting the value is given as D naught 1 plus G all over R minus G. This is the dividends over here. So let me explain it right over here. So the dividends, D naught dividends past, historical, current dividends. G is growth rate. R required return. And V is the value. Value right there. So having learned about the valuation approaches for public forms of real estate investments, we can then move on to private forms of real estate investments. Private. Under private, we have 3 approaches. We have number 1, the income approach. Income approach, where we value a building based on how much income is getting. So we need to get the value is given as the net operating income divided by cap rate. Cap rate is given as the discount rate minus growth rate. There. So this is the income approach. So you're supposed to get the value of the real estate is based on net operating income, how much income is coming to the building or how much income is coming to the investor. You divide by an appropriate cap rate there. Then the second method, so we're still looking at valuation methodologies over here. Now, second method, number 2, because that was number 1. So number 2, cost approach. We're saying that the cost approach determines value based on how much was used to improve the real estate. Like that. So it's based on the cost that you have spent on improving an existing property or renovating an existing property there. Cost approach. Number 3, sales comparison approach. Sales comparison approach. And here you are basing the value of the real estate based on competing properties. So we are saying that the properties, this is the property you're trying to determine the value of. You're saying that you could have properties that are like this, that. So this is the property you're trying to determine the value of. You base the value of this one based in terms of square feet. So the average number of square feet over here can be used. Average value per square foot of these properties can be adjusted for age, can be adjusted for condition, can be adjusted for location, and so on and so forth like that. So that is what you're saying. You determine the sales comparison approach based on competing properties just beside your building there.